Good evening and welcome to Your Money, Your Call. I'm Chris Kimber. If you've got a question about shares, our phone lines are open right now on 1300 30 34 34 35, or if you prefer, you can email us on yourmoney@skynews.com.au. I've only said that number 4 million times. Welcome to the program. Tonight with me in the studio is Roger Montgomery from Montgomery Investment Management. Now listen, Roger, you've managed to avoid some of the underperforming sections of the market. Some of these growth stocks, you chose not to be and they've underperformed. What are you doing now? Are you doing much of a mix around with what you're up to?
What's really interesting is the last 3 years in April, if you'd sold out April, May, then you would have avoided a 10 to 20% decline in the market. In the
ASX 200.
Yeah, from April through to June 30. And again this year it was the case. But this time what's happened is that we've found that a decline in the market hasn't resulted in a commensurate lift or a corresponding lift in high quality companies being cheap. So we can't find many things at all, and I know that's something I'm often saying. There are a few things, and we'll certainly talk about them tonight. We'll talk about them when we do that 30-second thing, where we're supposed to summarise, everything about a company. And we'll do that. And, we love it. So we'll do that. So there is a little bit of value, but we have been taking profits. In this rally. We've been disappointed by what management have done in some situations. We've met with some managers of companies that we own shares in, and they've told us they're committed to staying with the business and they've left, or they've resigned. Or we've discovered that there's a clause in a contract that somebody has with a supplier or a joint venture partner, and that clause is not what they told us in a meeting. And so when the actions don't match the words, we've got to sell irrespective of what the price is.
We definitely won't raise any money. And then they do that. Sorry, that's my favourite.
But let me say this. I think there are some sectors of the market that are ripe for mergers and acquisitions activity. And I'm hoping that we'll get some questions about that tonight, and we'll talk about that.
If we don't, I'll ask you.
Okay.
We're going to start out with Brian from Brisbane. Thanks for your call, Brian. How can we help you this evening?
Hi, Chris. I'm just ringing, you'd know the share I'm talking about, Atlas Iron.
I know a lot about Atlas Iron, yes.
You do. I bought it back in May at 270 odd, and then rebought it again for about 224. And it's gone down since.
169
what should
today.
I do? Hold or cut my losses? What's your latest on it, Chris?
Listen, look, it's an excellent question, Brian. Probably two worst performing stocks, the three worst performing stocks out there, I think, the last 12 months would probably be Rio, Newcrest, and probably Atlas Iron. We started in Atlas Iron at about $1.72 in late 2010, and now we are, whatever we are, July 2012. In the meantime, the stock did get up to around about $4.30, did very well. It's come all the way back. Now, really, the key to this discussion, Ord Minnett put out an excellent result last night, and all three of us on this panel are all going to have something to say about this. But they put out another great result saying that the global marginal cost of production for iron ore is still around about $120 and $125. Now, our pure iron ore stocks, our Fortescue, our Rios, our Atlas, a lot of these companies are trading as though the resource boom is over, and our iron ore prices are $70 and $80. Now, that's why I didn't sell my Atlas when they hit $2.50 and then they started to fall, and I'm still a shareholder at these prices. Atlas has got a little bit of an extra issue, is that they may need to raise some capital, which I think is why they're trading below $2. I wouldn't be selling them at these prices because I don't think we're going to see iron ore prices drop off much more over the next couple of years. So I'm going to maintain my position there because I think China's going to keep growing at 8%, and we're going to keep doing that. Now, I think we might actually go to Roger first for your in the middle, and then to Ben after that. So
a couple of points.
Single commodity for stocks for a start you don't like.
I love getting the questions that we can spend the next 15 minutes just talking about. It's just great. So over the last 12 months, and viewers who have been watching the program when all three of us have been on, have noticed that you guys all get a bit of a laugh when I give my intrinsic values for Newcrest, Rio and Atlas. And, I was the odd one out.
Absolutely.
Well, they're coming right, if you have a look here, they're coming, Atlas is now coming right back to our estimate of its value. But before I talk about that, can I just talk a little bit about iron ore and this idea of a floor?
Okay.
So the theory goes, for those who are interested, the theory goes that because the global cost of production is $110, $120 a tonne, then if the price drops below that, the marginal producers will stop producing, China will stop producing, and therefore they will buy our iron ore, and so they'll get it from us, and that'll be good, and so we'll be able to ship more volume and whatever. 2 points. One, the Chinese care more about employing people than they do about the profits of their smelters. Steel dumping globally by China is evidence of that. So this idea that it provides a floor is a furphy, and it never has in the past. Right? When the iron ore price, I guarantee when the iron ore price between 1985 and 2004 was trading between $11 and $15 a tonne and never went out of that range, I guarantee you that the marginal cost of supply wasn't down there, and it hasn't risen to $110 since 2004. So the reality is that companies, they still need it. It'll be made at a loss. It'll be made by the countries that are happy to take a loss on it. What won't happen is that companies that are profit motivated, or countries that have profit motivated companies producing it, Australia, for example, they won't continue to supply, and they'll have to defer production, they'll have to defer projects, and that's exactly what we're seeing. And I'll give you some insight. This week, or last week, I spoke to 2 potential clients who are in the mining services space. Either they're consulting geologists or consulting asset managers, so they manage the big yellow trucks for safety and environmental impact. And so they have both told me that where 6 months ago they were told, get the rigs, get the people, just get it done, make it happen. Now they're saying, look, we'll look at it again in 2 years. So that's good for prices of iron ore, because it means maybe we won't supply as much, strangely. But it doesn't mean that the iron ore price will stop here. And everyone needs to understand that it could fall a lot further before it actually becomes interesting to buy these things. I would want to see an overreaction on the downside, and I don't think we've seen that yet.
And that's my question, and sorry, I will go to Ben on this. We don't want to keep going for
sorry,
too long.
Ben.
Sorry,
I
mate.
forgot you were here.
But I just want to ask you, you talk about an overreaction on the downside. On any fundamental basis, and we're talking about your intrinsic value, if you plug in spot iron ore prices, the reason UBS...
Don't plug in. Why plug in spot? People are plugging in spot at $145 a tonne.
Because how far ahead can you do this? If iron ore prices stay at $120 for 2 more years, are you going to price your Rio Tinto shares on where they might be in 3 years? Is that how far ahead you're looking?
In the early days when I started on this program, I was a bit nervous about what I was saying, because of the cameras.
I don't believe you.
Hard to believe, but
you were never nervous about what you were saying, but yes.
And I'd come on and I'd be very cautious, and I'd say, look, the difficulty with these companies is that their value is based on the price of a commodity, and it's very hard to forecast the price of a commodity. That remains true today. You don't know. You're looking at, Morgan Stanley put out their metal strategist, global metal strategist, put out a forecast for his long-term iron ore price. So this year it was $140 a tonne. Then next year 130, and then the year after 120, and then the year after 119, and then 115. When in the history of the world have commodity prices gone in a nice straight 45-degree line down or up? They never have. And so we'll get overreactions, and that's what we're going to see now. I think the boom is over. I think it's over, and I'll explain why later on. We'll talk about. Sorry, I've just got to add. For as long as we've had markets, we get booms and busts in commodities. And that this is going to be no different. There was 2. If I could just give you some stats. Global iron ore production increased by 8% for the calendar year 2011 to 3.8 billion tonnes. Sorry, 2.8 billion tonnes. And by 2015, global forecasts are for another 700 million tonnes of annual production. Now, China takes 60%
Which BHP's
of global
already
production.
talking about chopping, though.
They're
already talking about not doing this.
No, exactly. But the interesting thing is that China takes 60%. China takes 60%, and of that, if they continue to take that 60%, they don't need it, by the way. If they continue to take it, we'd be fine. But they don't need that much iron ore. And there's going to be an overhang of supply. And the problem is mines have committed to production, and they will produce some more.
All right. Now, of course, the three of us have talked way too much for the first quarter of the show.
I can hear them in our ear.
All three of us.
Going in our ear. Would you move on?
No, that's it. And I'm sorry for everybody lining up to ask questions. We'll be much faster in the second quarter. But we're going to take a very quick break. And, of course, before that, we're going to put Roger right on the spot right now with a Stockwatch to find out what he's watching at the moment. And his time starts in around about now.
I think Flight Centre is a company that's widely followed yet misunderstood by the market. Most people are focusing on the short term, and that is the number of people flying overseas, and they follow the Australian dollar. But the company is growing massively offshore, and that'll surprise in the years ahead.
Keep going, keep going.
I've got nothing else to say.
You've got nothing else. Another stock?
Enjoy
8
the
seconds. enjoy your last 5 seconds.
I think it's cheap.
Okay. Thank you very much.
Intrinsic value.
Welcome back to the program. My name is Chris Kimber, and my panel of experts are here to answer your share market questions. Tonight we have Roger Montgomery from Montgomery Investment Management and Ben Clark from TMS Capital joining me. If you'd like to answer a question, if you'd like us to answer a question, please call on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Darren from New South Wales, thank you so much for waiting on. How can we help you?
How you going, Chris?
Very well.
You got my 2 favourite money managers on tonight, so
Excellent.
I figured I'd have to call and get
What
them
about
the
me?
question.
That's 3, mate. You can't just have 2.
Maybe what you were one of them.
Yeah, you're 1 on 3. The first one is CSL for Roger.
Yep.
I've owned it since it was down at $31.
Yep.
Has it run its course temporarily? And what's driving the share price?
Yep.
And for Ben, Panost.
Panost.
Yeah.
Yep.
Can you tell me about the mine life and the assets that they have, and long-term outlook for copper and gold?
Yeah, listen, I think both excellent questions, Darren. CSL and Cochlear both been defensive stocks, been performing very, very well. So look, Roger, you can rock on with CSL if you want, or do you want Panos first with Ben?
I'll talk about CSL really briefly.
Yep, really briefly,
so that you can have a bit of a turn.
Yes, okay,
and
that's a good idea.
Briefing on CSL as well.
Yeah, you have a bit on CSL. Okay, so I actually think CSL is a mining company. And they're a mining company that has a product that isn't as cyclical as most materials.
Yep.
They mine blood.
Yeah.
And there's a ready supply, and there's a rising demand globally.
Yep.
We own CSL, so I have to declare this. We've owned it for quite some time in our portfolio. It is one of our bigger positions. We think the market constantly worries about the Aussie dollar and the translation of overseas profits to the Australian company and therefore back to Australian dollars. And they always forget what a high-quality company this is. It does seem to be a bit expensive now. I'll give you the intrinsic value estimate that we've got for it. So our estimate for value for this year, 2013 financial year, is $35.59. So it's trading well and truly above that at $42.70 or thereabouts. But it's one of those that I say to my team, I say, look, if it ever gets below intrinsic value, we buy it and we just never sell it.
Right, yeah. So you don't trim it, you maintain your holding.
Same as Cochlear. It's just too hard to buy a lot of it when it's cheap.
Yep.
And so we'll keep adding if it ever dips, and we just enjoy the rallies when they come. But this will be worth potentially 3 or 4 times more in 5 years' time.
All right. Listen, Dan from Western Australia, thanks very much for waiting on. How can we help you, mate?
Oh, hi, guys. Thanks for taking my call.
Yep.
My question tonight is about whatif.com, and the code is WTF. It's a company that I've watched for a long time but have never bought shares in. I've had hesitancy towards it because I've always questioned the sustainability of its competitive advantages.
Yeah.
I just want to ask the panel, what do you think about the long-term prospects of this business? Is my hesitancy towards it too severe, or do you think that these competitive advantages that it may have displayed in the past could well be on borrowed time? Thanks.
Yeah, listen, look, I think that's an excellent question. Look, what if is not something that's made one of my portfolios, and probably for some of the reasons that you just mentioned then. So, look, I'm not convinced. I'm not up to date with what's happening. I'm going to hospital pass to you, Roger. I'm sorry.
Hopefully,
it's great. Yep.
I wonder whether or not you read my piece,
there
Dan,
you go. Yep.
which I wrote maybe a year or 2 ago about what if. I wrote a piece. The stock had rallied, and I questioned the sustainability of its competitive advantage as well. Generally, these businesses, their competitive advantage is the network effect, and that is the ability for them to attract on the demand side attract individuals to their site. And then obviously they get more deals because people see that they can sell their product through that site.
Yeah.
So realestate.com is an easy example to explain because more real estate agents put their properties for sale on realestate.com than anywhere else, or .com.au, because more people are viewing it. And more people are viewing it because there's more houses. And it's a virtuous spiral. I questioned it. I got a really terse letter back from the CEO when I wrote that piece saying no, we have got some strong competitive advantages. That was 2 years ago. That was mid 2010, and the share price is a lot lower than it was at the time. The intrinsic value, the important thing to understand is if a company has a sustainable competitive advantage, it's able to sustain a very high rate of return on equity on growing amounts of equity. And if that doesn't happen, then even if there is potentially a competitive advantage, it isn't a valuable one.
Yeah. And
so this particular company, its intrinsic value is going sideways over the next couple of years. The share price has come back to its intrinsic value now. So it's trading at about our estimate of its value. But that value, we don't expect it to increase substantially. And I think Webjet are doing a better job online with flights than Whatflight. I was really excited when What If announced their Whatflight product. I think it's a better product, but they just haven't got the traction. The reason they haven't got the traction is because Webjet have got the network effect.
I think that's fair enough. That's a great answer. Thanks for that, Roger. Listen, I think we might go to the next one, which is Karen from New South Wales, and she's asking about quite a popular stock that we hear about all the time. Karen, how can we help you?
I want to know what the difference is between a Linus Mini as against a normal Linus share.
Okay, excellent. Thank you very much. Sorry, that's a different question that I thought you were going to answer. First of all, Linus being one of the most volatile stocks we've seen on the market over the last year, with brokers valuing the stock anywhere between 50 cents and $4, still trading back below $1. And I know Ben was thinking about having a punt of this stock around about 95 cents and has made some money out of it. The difference between Linus and the Mini is that you can lose all of your money really fast in the Mini, where it takes a bit longer to lose your money in Linus.
But the end result's the same.
The result may be the same.
The end result's the same.
But look,
we can just give it to us.
That would save a lot of time and effort.
Correct. Worth making the observation that, you know, with these types of businesses, you can have all the fundamentals lined up and it all makes sense.
Yeah.
But it can take a very long time for the price to catch up with any perceived intrinsic value. And this goes back to this idea that in the short run, the market really is based on sentiment.
Yeah.
You know, that prices will move totally on sentiment and fundamentals have no bearing at all. But if you're patient enough and you buy the right companies and you get it right, the market will eventually reflect the value of the underlying stock.
Yeah, I think that's...
But if you, it might surprise... Can I just say one more thing?
Yeah, no, go,
It might surprise people to know, we've talked about America for a long time, really high unemployment, retailing is a basket case, you know, interest rates near zero. When are they going to come out of this prolonged depression/recession, or are they just going into another one? And yet, the total return index for the Dow Jones and the S&P 500, it's above the pre-GFC highs, or it's right at the GFC highs. Or pre-GFC highs. So you can't use fundamentals to invest unless you're prepared to look at it very long term. And that's what we're trying to do.
And you don't invest in the index.
Correct.
You actually try to pick a few good stocks. That's exactly right.
So it's just vital that you're patient with these things.
Excellent. I think that's great comments. Thanks, Roger. Welcome back to the program. Our panel tonight is Roger Montgomery from Montgomery Investment Management and Ben Clark from TMS Capital. Keep those share questions coming. Call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Tim from Victoria, how can we help you, mate?
Hi, Chris. Good to speak to you. My question for the panel tonight is about ACRUX, ACR, and I think it's one that Roger might know something about. I've been following this one for a couple of years now, dipping in and dipping out. I picked up the 16% special dividend they had last year. But rather than trading it, I'm wondering if the panel think it's a good stock to put in your super for a longer-term hold, whether it can turn into a CSL of the future, and at what point they would see that as good buying, good value buying.
Excellent. Listen, thanks very much for your question. ACRUP's 16-cent special dividend and becoming a CSL, that sounds like a pretty big call to me, Roger.
Well, it's the company's about administering drugs through the skin. It may indeed become a bigger business than it is. It's hard to see that far ahead that, you know, in this space, because technology can change so rapidly and new technology can emerge so quickly, it's almost impossible to foresee that far out what the competitive landscape would look at. So to be able to predict whether it's going to be a CSL or the next CSL is fraught with risk in this particular space. It's, it's high tech, really. Having said that, though, the second part of the question was, what's our intrinsic value estimate for it? For 2013, I'm going to disappoint the caller and say that it's $2.17. That's our estimate, but that does rise substantially to $3.44, which is about 40 cents lower than where it is now, around the $3.80 mark. So I don't own it, and I wouldn't be buying it at these particular prices.
Other things to do. Excellent. Great. Thanks very much for that, Roger. We'll go to George from Perth. How can we help you, George?
Yeah, hi. I'm just bringing the argument back about the discussion back about iron ore. And I've got a question for Roger. I'm just looking at his scaffold product. I've brought up Fortescue. And he's got an intrinsic value for Fortescue at the moment of $7.04 versus a current price of $4.13. I'm just wondering whether that analysis has taken into account his view on where he sees the price of iron ore going in the near future.
I think it's excellent. We might just do 30 seconds with Roger and then Fortescue for Ben.
Okay, so that forecast intrinsic value is based on current estimates for the earnings of Fortescue, and those current estimates don't factor in any dampening of the iron ore price. My personal view as a manager, my personal view is the iron ore price could fall a lot further, and therefore those intrinsic values would be re-rated or derated. They'd come down more. Those intrinsic values change every single day based on forecasts for the company's earnings. So you've got to keep that in mind. What I've learned over the years, and you guys know this, but what I've learned over the years is that some analysts are very good on some stocks. And if you talk to the CEO of a company, one of the last questions that I'll often ask them in an interview is which analyst do you reckon does a good job covering the stock? And he's not going to, he never says, that CEO never says, oh look, they're all really good. He'll say, oh listen, talk to this guy, he's spot on. He knows the business. And it's true with every, a lot of these analysts, I've got a lot of respect for them. They're rated, highly rated. They've been in the industry for a long time, and they know their business. But there's also a lot of young analysts out there who still get their mum to do the washing. And you've got to be careful. They're in the consensus numbers.
Your mum to do the washing. That's there. Lindsay from Sydney. Hi, Lindsay. How can we help you?
Oh, hi. I hold Kingsgate Gold, and the chart's looking pretty awful of late. I was just wondering if the panel had a view on whether it's something to hold or time to cut and run.
Listen, thanks very much, Lindsay. Look, there's only two gold stocks that I'm holding at the moment. One is Newcrest, which I bought too early, but luckily I bought some lower. It's starting to look a little bit better now. And the second one in is the one that Roger put me into when it was about $1.52. Thank you very much, which is Silver Lake. Which got all the way up for a capital raising at $3.40. It's just come back down to $2.67. My feeling would be I'd rather be in Silver Lake at $2.67 rather than Kingsgate, because now Silver Lake's also got a copper deposit. Have you just got a quick little gold? And,
my view is that the gold price, if there's another quantitative easing, I think this quantitative easing they might actually get it right. So I'll just very quickly, what they've done in the past is that they've bought the bonds off financial institutions. Those financial institutions haven't had any money, so they've hoarded it and it's not gone out into the economy. But this time what they've worked out is if they buy the bonds from life insurance companies and pension funds and mum and dad investors, the money will go out into the economy, and that could be potentially inflationary. That would be good for gold. So we're hanging on to our Silver Lake.
Excellent. Welcome back to the program. Joining me in the studio tonight are Roger Montgomery from Montgomery Investment Management and Ben Clark from TMS Capital. My name's Chris Kimber. It's great to have your company on a Wednesday evening. Tonight we're talking shares. If you'd like to get in the conversation, please give us a call, 1300 30 34 35, or email us at yourmoney@skynews.com.au. Joanne from Melbourne, how can we help you this evening?
Good evening, gentlemen. I'm just ringing to inquire, please, what the panel think of Fortescue Group. I know Roger has been very keen on it, and I have bought some, but I've noticed it's gone down in the last month or two, and I'm just wondering whether there's a reason for that, and what he thinks about it and what Ben thinks about it. Thank you very
Joanne,
much.
Thank you very much. I think it's an excellent question. I think you might have found that Roger bought and sold this stock last year as part of his mining services trade, but just maybe a quick bit on
very
Forge.
quickly. Yes, we did. We talked about Forge a lot on this program. We sold all of our mining services holdings, almost all of our holdings, and certainly all of our Forge in April. And I wrote about that on my blog as to why we did that. We talked about it on the program. It's related to my iron ore thesis and the increase in supply at precisely the time that China needs less, and they're a mining services business. And that's the reason why we sold it. We also saw that intrinsic value was flattening out over the next few years. It's another reason that we don't own it anymore.
All right, Jajir from Melbourne, how can we help you?
Yeah, hi Chris. My question is about CBA and NAB. I've held them for a while. I enjoy the dividends and the franking credits in my super fund. My question is, what would the current valuation be, and also in a year or two?
Yeah, listen, I think it's an absolutely excellent question. Look, there was two stocks last October when the index was 3,900. We did a big show. I'm not sure if the three of us were on it. We went 10% of people's portfolios in Telstra's in the 270 and 7% in Commonwealth Bank at 44.50. At that stage, the three dividends were something like 15% fully franked over 13 months. I started reducing my holdings in Commonwealth Bank probably about $1 ago, although there is another dividend coming up. It has been basically all of the people that have been sitting in cash that have been missing out on dividends are now flooding into that. We're getting money coming from overseas flooding into that because they can't get the return from anywhere else. I think their result would be reasonable. I think they're getting pretty fully valued. If you want to put them in your bottom drawer for the yield for the next few years, do that. But I will have less. I'm not selling all of my Commonwealth Bank, but I will definitely have less Commonwealth Bank in my portfolios over the next couple of weeks. Roger?
Very quickly, CBA is definitely the star performer in the bank, them and Westpac. But if you're looking for credit growth potential, then you'd look at ANZ. NAB has not increased their intrinsic value in a decade. Their share price today is less than it was 10 years ago. So yes, you've got a reasonable dividend yield through that period, but the opportunity cost, you could have got a good dividend yield in a company whose intrinsic value's increased substantially. You know, a Campbell Brothers in the last 10 years has gone up, you know, many times, you know, in terms of its multiples. So yeah, I wouldn't be interested in the NAB. CBA's okay, but it's expensive now.
All right, no worries. Listen, we also got several emails this evening about Breville Group. BRG was up 5% after a cracker of a result. I think the stock was $5. I just want to get some comments on Roger on that. I think it was one of the stocks in his portfolio last year. Listen, Roger, that's a very sharp rise over the last thing. Are you going to maintain that in the portfolio?
No, we don't think the return on equity... The analysts are forecasting 26-27% return on equity for the next few years. We think it'll mean revert, and we think that return on equity is actually going to come back over the next couple of years. Out 2 years, and so we think it's a little bit expensive at this price. I'm conscious of the fact that we're going to wrap up the program shortly. But can I give one quick plug?
Quick one.
Our fund has $1 million minimum, so there's a lot of people who wanted to invest with us and haven't been able to. But in 2 weeks' time, we're going to launch a retail fund, which will have a $25,000 minimum. So if your viewers go to montinvest.com, montinvest.com, we'll send them, if they've registered on there, we'll send them a PDS in the next couple of weeks.
Excellent, no worries.
Thanks.
That's all we've got time today. So thank you so much to our guests, Roger Montgomery and Ben Clark, and for all of your phone calls and your emails.